I think one of the reasons why at Bridgewood we really enjoy this type of a conversation is because at the core of what we're doing, yes, we're helping people buy and sell companies, but at the core we're really helping individuals build wealth through the ownership of a business and maximize that wealth when they decide to exit the business. So it's something that's very near and dear to our hearts. And I'm going to talk about 3 hunks of information real quickly here. First is the current M&A market, followed by a brief discussion about building wealth through proactive acquisitions, and then I'm going to wrap up just talking about thoughts on timing of selling a business. So the M&A market, and what this is a kind of a neat view because it's a 12-year snapshot of M&A activity. And you'll see that the completed transactions increased about 50% between 2003 and 2007. A very big ramp up of M&A activity there. And then dipped, of course, during the recession, and then rebounded in 2010. Now, 2010 and 2011, which jumped up quite a bit from the recession, is a little deceptive because if you think about it, there were a number of troubled deals going on during that time. So keep that in mind as you look at this graph and as you interpret it. And then in 2012, another essentially record year. A lot of that was driven by the capital gains increase that came in 2013. So a number of deals from 13 were pulled forward into 12, making 12 higher and 13 lower than you might normally have expected. So just keep that in mind as well. And I think the takeaway here, if you look at this, and you just kind of drew a line from 2003 all the way to 14, a very nice steady ramp with, of course, the ups and downs leading up to during the recession. And 2013 and 14, really solid years, and there's no big anomalies there. There's not a lot of trouble deals going on. There's not a ramp up because of taxes, etc. So very solid M&A activity going on as we speak. So that's the activity level. The next slide shows business valuation trends. On average, what are companies being bought or sold for as a multiple of their trailing EBITDA, or essentially their cash flow? So first you'll see that the valuation multiples increase considerably based on the size of the transaction. The blue bar on the right of each year is larger transactions of 100 million to $500 million, and you'll see those multiples in 2014 third quarter at almost 10 times EBITDA. Yet for businesses 25 million down to 10 million, that multiple was only 5.4, nearly half. And this is because larger companies are typically seen as much more sustainable. They may have better and more long-term management in place. You can draw a larger population of buyers. There's greater access to financing for larger businesses. The other thing to highlight is that the deals that are less than 100 million and the smaller transactions, it's much less variable as far as what is being paid. From 9 to 10 for large deals, went from 8 to 10 and back down to 9 and then back up to 10 again. There's quite a bit of variation there, but if you look at 25 to 100 million, it's 6.3, 6.3, 6.6. I mean, it's just kind of slowly ramping up. And so much less variable for smaller businesses. One note on this, because when you see the $10 to $25 million transaction multiple down in 2014, that's what the statistics happen to show at that time. It can be skewed by certain deals or what have you. At Bridgewood, we're actually seeing stronger multiples right now for our clients, and I think across the board, that's really more the case of what's actually going on. So the takeaway here, and you'll see it at the top of each of these slides on the M&A market, is that it's a seller's market now. The good companies are in high demand and commanding premium values. So if we take a look at what's driving M&A activity, it's a simple analysis of supply and demand. On the supply side, you've got business owner demographics, a lot of baby boomers looking to retire finally. Maybe they've held off because of the recession. Private equity holdings are at record highs. There's a lot of companies owned by private equity groups that eventually do need to be sold in order to return their profits to their investors. And still there's a shortage of sellers on the market. We're starting to see that change. Our most recent clients were all sellers that have signed up Bridgewood in the last few months. So we do see that changing, but historically, up until now, there's been a shortage. There is not a shortage of demand from buyers. So when you look at that side of the coin, it's very difficult to grow a business organically. And so strategic buyers tend to be doing that lately through acquisitions in order to get into new markets, new geographies, etc. They've got a lot of cash, and private equity groups have a lot of investment dollars ready to put to work. Banks, of course, are lending again. It's a very active market, and rates are at historic lows. So what can a business owner consider doing to build the most value in their business? And that's kind of what I'll talk about next. I think it's two things. I think it's growing the business while you own it, and then maximizing the value when you go to exit. So that's, as we move on here, we'll talk about building wealth through acquisitions and kind of the analysis of how should you make acquisitions if that is something that you're meant to do. Should you be proactive about it or just react to companies that come to you? Acquisitions are an increasingly attractive way to grow a business, particularly when it would be difficult or expensive to create that growth organically. And at Bridgewood, our philosophy and kind of what we preach, and you'll see it in an article at the tables on the side of the room if you're interested, is that buying businesses in a proactive manner makes a world of difference. Just look at it this way: if you saw a company that was for sale and it came to you and you said, okay, well, cool, I'll take a look at this. This might be a fit. And you kind of get excited about it, and you're looking at it, and you're, yeah, I'd like to go for this. How do you know that that acquisition is the best acquisition to make at that point in time? Because there are no other businesses for sale, let's say, and so should you do that deal? Well, the question, you really can't answer that unless you're being proactive about acquisitions, and you know what all the other targets that you could buy or would want to buy, what they're doing and their interest at what level. So that's why when we talk about acquisitions, sure, we could help someone analyze and get a deal done on the buy side, but what we really do is we conduct an entire acquisition search. This is what we would propose any buyer should do, is really be proactive about it. So to prove that makes a difference, we conducted a survey of all Wisconsin-based serial acquirers, companies like a Briggs, etc., who are very good at making acquisitions and do many transactions over a period of time. And so we asked them how many of the deals that you completed were proactively sourced, where it was not being sold, it was not a for sale marketed business, it was just a company you approached. And then how many were you reactive? Well, 3/4 of their acquisitions across over 100 deals were proactive. And so, first of all, that just points out that serial acquirers are largely doing that through proactive efforts. And then we asked them, well, of the proactive deals that you completed, were they successful? And 85% of those deals were successful as they measured success. And that is a very big difference compared to the 50% average success ratio of acquisitions that you read about in nearly every study that's been done on the topic. So what we really were able to confirm is that by being proactive and not waiting for companies to come to you for sale and saying, here's strategically what I want to accomplish, here's the 30 companies that could be a great fit, and then going after them in the right way and approaching them and entering discussions, you can create sellers that otherwise are not available. So that is just a word or two on acquisitions and how we've really seen a number of company owners build wealth. We had one client, for example, that did this. They were about a $20 million business that saw a big decline in the core market. And they knew they needed to get into other markets, which is very difficult to do organically. So they did a series of 4 acquisitions over about 4 or 5 years. Ultimately grew to become a $100 million company and sold to private equity roughly 10 years later. So it's a nice look back that we have just to see what a difference that can make. And my last topic is monetizing your largest asset. This is kind of the other end of the equation, is when to sell. For many, selling their business is monetizing their largest asset. We get this question a lot as far as, is this a good time to sell? And the answer is really difficult for every company, and there's not necessarily one specific time that's best, but I believe there's an approach you can take to be sure to optimize the timing of the sale of your business. And that's really just to monitor a few overall timing factors and watch for more than one to converge. So watch for 2 or more of those factors to converge at the same time. So up on the screen here we have the business itself. This is it growing? Have you optimized your profits? It's, by the way, generally best to sell when you have some runway left and your business isn't at the top and starting to look downward, but really still growing. And so that's a very important thing. So look at your business and monitor the timing, and would it make sense to sell if the situation presented itself? Economics. This can drive demand for your product or your service. It can also drive the supply and the cost of financing availability for buyers. And another example is reading in the Wall Street Journal yesterday is the strength of the dollar can make a big difference. And right now for companies that are focused on exporting, it's hurting because we have such a strong dollar right now. Personal, this is a big one, particularly for privately held companies, of course, but your personal objectives can vary a lot and they change over time and they can change unexpectedly. So consider things like your health, family succession of the business, or perhaps not, retirement needs and wants. So think of all those things, watch for them to gang up and have 2 of those together. But overall, you need to be flexible, prepared, and creative. And the reason I say those 3 things is flexibility is you don't know when maybe the right time could present itself. It's not necessarily when you're planning on. Being prepared means watching your business and making sure that at the end of the day, would I buy my business now? Just that's one simple question. Is if I was a buyer, would I buy my business? If not, get to work on making improvements so that you would buy your business yourself. Because I think if you would buy your business yourself, you'll generally be in a state of preparedness to sell when the right buyer comes along or when you want to proactively sell. And then be creative. And that really goes to the timing. And it could be that someone approaches you and it's not a bad time for your business. Maybe that's a time to look at it, even if it's before you wanted to retire. And then talk to your other advisors and see if you could swing retirement now or not. So be prepared is really a big opportunity. The bottom line, I guess, and just to kind of wrap this up, is I know of no better or no more enjoyable way to build wealth than owning a business. It just simply is a really great ride. It's challenging to grow sales and profits, but very rewarding when you do. And if you can leverage mergers and acquisitions to grow faster and also to exit better, you've done very well. So if there are any quick questions, that's great. I think we have a minute or 2, otherwise we'll continue.
Well, in my practice, we oftentimes deal with closely held business owners, and it's like another child. So we have to plan for that child, the business, as well as for the individual owner's other objectives. And the first thing that I typically ask a client when we're sitting down, whether it's for the first time or whether it's follow-up meetings as plans evolve, is what is your mission? What is your objective as we're going through this planning? Looking at it from the personal perspective, is there a desire to retire by a particular age or at a particular moment in life to move on to another venture from this one or retire completely? What is the family circumstance? Might there be a next generation that is interested in the business? And if not, what other family considerations come into play? We might have someone who has a special needs child, so the planning that we'll do in that environment is a little bit different than it might be for a different family situation. And then I also ask clients to think about their philanthropic objectives. If they are charitable minded, we like to keep that in mind, because as we're planning for transitions, whether it's retirement, the sale of a business, or end-of-life estate planning, if there are charitable intentions involved, there are some things that we can do to minimize the tax burden for families while also fostering that charitable mission. It becomes a win-win for everyone except for maybe Sam, who might get a few less tax dollars. The other piece that I always like to discuss is how do we convey that mission or objectives to the next generation. I'm a firm believer in family meetings. I don't think that you want to structure a plan that it surprises your loved ones at the end of the day. Now that doesn't necessarily mean disclosing every last piece of information, because you might not want them to know every last piece of information. But if there are some showstopper intentions that might not be expected, that usually ends up resulting in a bad result. And at the end of the day, you do want your family to be able to get together for Thanksgiving dinner and have an enjoyable time. So it's important that we convey that mission to the next generation, and we usually like to talk to our clients about how best to do that and preparing that next generation for what might come. In terms of how the business falls into that, it's very important to honestly assess whether the business can be moved down to the next generation, or whether a potential sale is in the cards in order to achieve the rest of your objectives. And that gets to the point that was made earlier in that you really need to optimize all of those things. You have to look at those personal goals, the trajectory of the business, and what might be an opportune time to sell if in fact a sale is in the cards. And if a sale is in the cards, there may be some steps that we can take prior to the sale, once again, to minimize some of those transaction costs in terms of taxes. So, want to know the mission. Now, one mission that always comes up is, what am I going to pay in taxes? And for many, many, many years, the big concern was estate tax. The estate tax historically has been as high as 60%. It has had an exemption amount, the amount that people could leave to their loved ones in the aggregate before they had to pay that first dollar of tax, of, back in the old days, only $600,000. Well, there's been a sea change in the estate tax. The estate tax exemption today is $5.43 million per person, which means that for a married couple, you're coming pretty darn close to $11 million in value that you can convey before you have to pay estate tax. The statistics would bear out that because of that change alone, the percentage of individuals that are potentially subject to the estate tax has dropped to less than 1% of the population. So the estate tax exposure is greatly reduced from the federal tax level. Now there are some states that still impose an estate tax. And what has happened is that you have to be cognizant of just the federal tax, but where you own property in other jurisdictions, particularly real estate holdings. The state of Minnesota does still have an estate tax, and they actually look through entities so that if an entity owns real estate in Minnesota, you face potential estate tax exposure there. So you have to look at this on a balanced approach, not just federally, but also from a state basis. Now the tax rates federally have dropped to 40%, and it's a flat tax. There's no longer a sliding scale of taxes. It's 40 cents on the dollar for every dollar over $5.43 million for each individual. Again, double that for married couples. And that amount is indexed. The exemption amount is indexed for inflation. So we're going to be seeing it going up slowly each year. It went up by close to $100,000 this past year. And that will continue. Also new, relatively speaking, is the concept of portability. Back in the old days, in order to take advantage of that exemption amount in a married couple situation, at the time of the first death, we had to put money into a trust or distribute funds to someone other than the surviving spouse in order to utilize the deceased spouse's exemption. Many married couples didn't want to do that, but they did it anyway because they wanted to avoid taxes. With portability, we now have the ability to preserve the unused exemption at the time of the first spouse's death and make that available to the surviving spouse. like with just about everything in the tax universe, there's lots of rules that apply. You can't accumulate hoarded exemption for multiple spouses. You only look to the last spouse. So no black widow planning is allowed. But it really does change the environment in terms of our estate tax planning. And we do still have, despite the President's most recent address to the nation, a basis step-up at death. And what that means is that any assets that pass through an individual's estate at death are treated as though they were acquired at the full fair market value as of the date of death in the hands of the recipient, in the hands of the beneficiary. So for clients that hold what I'll call legacy assets, assets that have very low basis that they hold for many, many years, it actually is quite advantageous to hold those assets until date of death because you get that full step up in basis. If you gift an asset during lifetime, the individual receiving that takes the carryover basis in most situations. There are some exceptions to that where it might actually be lower if the value has dropped. But in most cases, that individual takes the carryover basis. So from an estate tax standpoint, if you look at the screen on the left-hand side, you'd look at that on balance and say, you know, I'm not real thrilled about paying 40 cents on the dollar. But on balance, those rules are significantly better than they have been through the years. Now we go to the right-hand side, and unfortunately there the news isn't quite as good. And that is because on the income tax side of things, the movement has been towards collecting more in terms of taxes from individuals. Top marginal income tax rates have increased to 39.6%, and that actually can be misleading because there are a number of phase-outs, personal exemptions, dependency phase-outs, etc., along with the dreaded alternative minimum tax. The top rate for capital gains and qualified dividends has increased to 20% from 15%. And then layered on top of all of that, we have a new net investment income tax of 3.8% on certain investment returns for, quote, high income taxpayers. You add that all together, and whereas in the past, the estate tax for most people who were subject to it was significantly higher on a percentage basis than the potential for income tax. And at best, it's equal. At worst, the income tax is now higher than the estate tax when you look at those high net worth individuals. So many of the planning techniques that we used to use to avoid the estate tax, we have to balance those against the income tax consequences that come with them. For individuals that, as part of their business succession planning, were gifting interests of their business to their children because they thought they could leverage valuation discounts, that you can still do, and the like, may still be a good plan if you think there's going to be significant appreciation and you think you will be subject to the estate tax. But if you're continuing to make those gifts out of habit, and you're really no longer subject to the estate tax, remember, married couples at an $11 million level, you may, instead of decreasing your tax burden, be actually increasing your tax burden because of the basis carryover. Your children or your other loved ones are going to receive that stock or that business interest at a carryover lower basis so that when the business is sold, because you've worked with Bridgewood and they've done a fabulous job of finding you a buyer, they're going to be surprised with the capital gains tax hit that they might not have had they inherited the asset. So it really it's a game changer. And you've got some other plans that have been in the works in the past where gifts may have been made to trusts that are really creating some surprises because the income tax rates that are applicable to trusts are very compressed. In the trust universe, for dollars that are retained in trust, you pay the maximum income tax rate at roughly about $12,000 in income. That's not a whole lot of income. So you really have to think through these things and make sure that we have the planning techniques in place so that it makes sense on both sides of that slide, both the income tax slide and the estate tax slide. Laura and I work together when we're dealing with clients on these matters because Wifley needs to know what the income tax considerations are for their clients. We work with the estate tax, and as a team, we come together to make a good plan. It's just very important to know that Right now, as we sit here today, the rules are very different than they were 5 years ago or 10 years ago. So it's important to consult with your advisors and make sure that you know what is best for you today. So that's the tax update. One good piece of news is Wisconsin does not have an estate tax, so you don't have to worry about that for Wisconsin-based assets. And although President Obama indicated that he did not like the notion of the basis step-up and referred to it as the trust fund loophole, I don't think that there's much chance that that's going to change in the near future, at least. Long term, very difficult to say. There have been a number of changes made in the federal law with regard to tracking of basis by brokers and other financial institutions that make the notion that you wouldn't get a step-up in basis easier to implement than would have been the case in years past. One of the reasons that carryover basis was actually ever approved in the first place was that it was very difficult for clients who inherited assets at times to be able to find out what the basis was. They just didn't know. Now there's systems in place to track that a little bit more if you're talking about publicly traded securities and the like. So stay tuned, it could change. For now, we have basis set up. So how does your business succession plan foster your mission? What I mean by that is, if you own your business outright, and you're the sole owner, you're probably not subject to any shareholder agreements. But if you have a partner and there's a co-owner of your business, chances are you have, or you should have, a buy-sell agreement or a shareholders agreement with your co-owners that indicates what would happen in the event of death or disability, those sorts of things, and so that you might have to exit the business. This is important in terms of coordinating with your personal objectives. If your objective is to pass your business interests down to your heirs because they're your heir apparent and they want to be active in the business, but your buy-sell agreement says you have to sell your stock at the time of your death, that's a mismatch. So how do we address that? Something has to give. Either your objective can't be achieved, or you have to have a candid conversation with your business partner to make sure that both of you, or if there's more of you, all of you, are on the same page with regard to what should happen. The flip side of that is, if you don't have a successor and you really just want to be sure that your family's taken care of with a liquidity event, then your buy-sell agreement needs to contemplate that. It has to call for a repurchase of those shares. And if it doesn't, your heirs are left to negotiate with your business partner what those terms of sale would be if they want to exit and access a cash flow from that business. So you need to look at those agreements, make sure it's coordinated with your personal goals and objectives, and make changes as needed. The next bullet point that I have on here is whether there might be other agreements needed, such as leases or employee retention agreements. If you are in a situation where you have one child or less than all of your children that might be heirs apparent to the business, but others that either just aren't suited towards it or have no interest in it, you have some planning to do, not just from a business perspective, but from a family perspective. Certainly you want your successors to be capable and skilled and have the tools and the knowledge to move forward on your business. But you also have to deal with that family scenario. Clients always want to be fair. That's a word you hear a lot. Fair does not mean equal. You really need to consider if there is a child that is the appropriate successor from a business management standpoint, whether there are other ways to achieve the economic objectives via your family in terms of whether it's dividing value equally, perhaps a child who isn't involved in the business becomes the owner of real estate, whereas the child that is active in the business becomes the owner of the operating company. It needs to be coordinated. And it's better to have that coordination done up front when you're able to be there and mastermind it than to have the children work it out amongst themselves later. Again, family discussions, family planning is very, very important to all of that. If you don't have an heir apparent, but you think you can groom one, it's important to consider whether you have the right employees in place to support that transition. You may have two managers that are willing to stay on and do that, but make sure you have appropriate employee retention agreements in place so that they're not fearful when a death occurs or you've exited the business, that they need to be looking for another position because the company's being sold. You want to make sure that they're there and they're there to nurture that company to the next phase, whatever that might be. And sometimes your objectives really do require a sale of the business. So let's plan for that sale of the business. You have to position the company for sale. You might work with Bridgewood to do that. If there's a sale that's anticipated, you have some pre-sale gifting options. You need some valuations, but if you wanted to make gifts of interest so that you might be able to push some of the capital gain recognition to family members, you need to do that earlier versus later to start getting some of that off of your side of the ledger. Keep in mind that if you have very young children, it's a great strategy to make gifts to move income to your children if they're in a lower tax bracket. That doesn't work if your children are subject to what's called the kiddie tax. So if they're under 19 or they're still full-time students under the age of 24, investment income is going to be taxed at your rates nonetheless. But if they're older, you might be able to use that as an option. Charitable options are also available. I'll talk a little bit about that in a minute, but sometimes we can incorporate charitable interests in order to minimize income tax or to possibly at least defer income tax. And then more importantly, from a personal perspective, planning for your life after the potential sale of a business can be more of a challenge than sometimes people give it credit for. Businesses are very important to their owners, particularly their founders. When they were there at the startup phase, it's really a part of their life. It's part of their everyday life. So you really need to do a little soul searching and figure out what that's going to mean to you if you're exiting the business via a sale, and also planning for the cash flow implications post-sale. Particularly with closely held businesses, much of your lifestyle may be funded via the business, your club membership. Maybe you go to a convention every year and that's part of your vacation planning. That needs to enter the conversation so that it doesn't become a shock to the system after you've sold your business. Okay, charitable missions. And this applies both with regard to someone who has a business to consider or not. One thing I do want to mention is that in terms of charitable planning, if you're charitable minded, probably the best assets to give to charity is something that's a tax-deferred asset. So if you have a 401k or an IRA and you want to name a charity as a beneficiary long-term, that's a perfect asset because not only is it out of your estate for estate tax purposes, the charities don't pay income tax on that revenue. If you left that to your children and it's a tax-deferred asset, and I'm not talking about a Roth IRA, I'm talking about a traditional tax-deferred IRA or a 401k, whoever receives that has to pay income tax on those earnings as those dollars come out. So if you're charitable-minded, that's always a technique that you can use that saves on both sides of that ledger, both estate tax and income tax. In terms of charitable giving, we can sometimes, if you're contemplating the sale of a business, and truly are charitable-minded, not just for quirky tax planning, we can sometimes incorporate charitable remainder trusts as part of your advance planning, whereby you retain a cash flow for a period of years and a charity receives the cash flow at the end of that term of years. If you set that up before you sell the business, that sale of the business on those shares that are in the charitable remainder trust, it's not subject to income tax right away. That trust is a tax-exempt entity. Now, as the cash flow comes out to you, it's going to carry out some taxable income, but it creates a tax-deferred opportunity for you to reinvest the full proceeds, maybe actually receive more in the long run in terms of your annual distributions, and spread the recognition of gain over a much longer period of years. We could talk about charitable remainder trusts for an awful long time, but I just wanted to tease that up to you. The key thing there is you have to set it up before the sale is arranged. The IRS will treat that as an assignment of income. If you cut your deal in, then you'd say, hey, it's a great idea. I'm going to transfer this to a charitable remainder trust. That won't work. So you need a little advanced planning there. In terms of how you can give to charity, obviously you can always make outright gifts. That's easy. Charitable trust we just mentioned. Family foundations versus community foundations, donor-designated funds, etc. Depending upon the size of the gift that you want to make. Some individuals really like the idea of a family foundation to get their children involved in charitable gifting, giving back to the community. I will tell you I have a personal bias. I probably wouldn't do that unless you were going to seed that foundation, at least at some point in time, not initially, with at least $1 million in assets. Otherwise, I think it's the cost of maintaining that foundation and the administration that's required really don't justify it. We have lots of good donor-designated fund opportunities and community foundations that are able to meet your needs if you'd like to make a donation today with long-term giving implications. So that's it for me. Does anyone have any questions?
So as Ann called it, quirky tax planning. That's what we're going to get to right now. Ann did mention about the marginal tax rates going up in 2013, and they're here to stay in 2014. So just a little review. That top rate is 39.6 right now, and it affects single tax filers at about $406,000 worth of income, and married filing jointly about $457,000. And she did also mention the 3.8% Medicare surtax, and that's affecting single tax filers at $200,000 of income and married filing jointly at $250,000 worth of income. And they would have to pay that 3.8% surtax on any net investment income that they have, which is interest, dividend income. It would not include tax-exempt interest from municipal bonds. She also did mention some capital gains rates changing from 15% to 20%, and that again is that same kind of rate at that 39.6 is where that kind of comes into play. And you could also have that 3.8% surtax on capital gains as well. So really the top rate for capital gains is 23.8. So with these higher income tax brackets, it really does make sense to really take this into consideration when you're doing your income tax planning as well as your wealth transfer tax planning. Let's just take a look at those trust rates that Ann was talking about. You know, they've a trust income at $12,150 hits that 39.6% marginal tax rate. That's really compressed. You really have to do some pretty good planning with these trusts now to avoid that. And again, if the assets within the trust are producing income from dividends and interest, it'll also be subject to that 3.8% surtax as well. So we might ask our friends here at Northern Trust, what level of assets does it take within a trust before it will start generating $12,150 of interest annually? And they might say, well, it depends. It really depends on what that asset is. If it's an appreciating asset that's not really producing much income, you don't really need to worry so much about those compressed rates as well as the surtax that may be applicable. But of course, if it's a liquid asset that is invested in stocks and bonds and is producing interest and dividend income, now you would be concerned about that. And probably as little as $400,000 to $500,000 within a trust would produce more income than that. So it really has become very important to include these income tax implications when you're considering wealth transfer. So say you're S corporation shareholder and you own an S corp and you want to transfer stock to the next generation. And you're using a little bit more sophisticated tax planning, and you're using trusts in which to do it. There are two different trusts that qualify to be S corp shareholders. That's an electing small business trust or an SBIT. Or you could use a qualified subchapter S trust, which is a QSST. Each of them are taxed differently. The SBIT is its own tax entity and would be subject to those compressed rates that we just talked about. And if the beneficiary of the trust is not active in the business, that income would also be subject to that net investment income tax, with that 3.8% surtax. So they've become a little unpopular as of late. And the QSST has become more popular. that income from the trust will actually flow out to the beneficiary and would be taxed at their individual tax rate, which we just saw were more favorable than the compressed trust tax rates. The other thing that you might consider, if you're thinking about transferring any shares of your closely held business, is a recapitalization of your stock into both voting and non-voting shares. What you would want to do is hold the voting shares for yourself. You would gift the non-voting shares, and that would allow you to retain ownership in your company and control. And also, you'll be able to get additional discounts with this valuation discounts. You'll be able to actually gift more to the next generation. So we talked a little bit about Dynasty Trust. These are trusts that go on for multiple generations. And they can be funded by either a gift or a sale. And we're going to go through an example of that in just a bit. They provide creditor protection. They also protect beneficiaries through divorce. Could also protect a beneficiary from themselves by having spendthrift provisions within the trust itself. So here's an example of an intentionally deceptive grantor trust. So a parent would create an irrevocable grantor trust. They would sell property to the trust, and in exchange for a promissory note with an interest rate at the applicable federal rate, which are at historically low amounts right now. They would also transfer some seed money into the trust to help make those payments back to the parent that has made the sale to this deceptive grantor trust. Now after this is all set up, how does it work? Well, the company will make distributions to the trust, since the trust now owns the stock of the company. Now the trust has money to make the payments to the parent. And because it's a grantor trust, the income is, the tax on the income is paid by the parent that actually made the sale to the trust. So us as planners think, well, this is a really good idea. You know, we're transferring assets. This is a Dynasty Trust. It can go on for multiple generations. We've got the parent that's made the gift, paying the tax, and this trust is going to grow for these generations into the future. The parent says, wait a minute. I just gave all these assets to my children and their children, and who knows how far this is going to go into the future. Do I really need to keep paying tax on this? And some of the planning that we really help our clients with is helping them determine, does it make sense for them to keep paying that tax over and over again? If they have a large estate, it may make sense, because now that's a way that they can whittle down their estate and transfer more to future generations by that trust not having to pay that income tax on the income in the trust at those compressed rates that we talked about. So again, you really have to listen to clients, and you have to really feel good about it yourself. We as planners can think it's a really great thing, but it may not be the best thing. So it's an intentionally defective grantor trust, meaning that at any time the grantor would decide, hey, I don't want to pay the income tax anymore. I want to make sure I'm retaining enough assets for myself to live comfortably in retirement, then they can turn off paying that income tax at any time they choose. And here we can see that transfers on to the next generation. So the reasons why planning is still viable. We mentioned that the interest rates are historically low. It's a very good interest rate environment right now. Valuation discounts are still around. They're challenged all the time. But we are still using those for our clients. And the economy has come around, but there still are some depressed assets out there that may be very good for transferring to the next generation. So we do feel that right now is a good environment to be making those wealth transfers. I will pass it on to Matt.
My fellow panelists accused me of having an unfair advantage in that I have some artwork in my presentation. Unfortunately, it's black and white, and I didn't create it. So, but I wanted to include this art in part because I think a lot of what Northern Trust does is less science and more of an art. Because my desk as a trustee sits at the intersection of road and rubber. Between the wealth creator and the heir. So I think this cartoon illustrates aptly one important issue that we've been dealing with lately. So I wanted to spend a few minutes talking with you a bit about how we've been spending some time with our families who have created wealth, and how we're working with the next generation of families to enhance their appreciation, respect, and understanding of that wealth. So I'll first discuss some of the political and financial dynamics that have raised the issue to prominence among our clients, and then I'll discuss some of the things that we've been discussing with our clients and their families to help educate them on wealth and its responsibilities. We are currently in the midst, as everyone knows, in an era of great wealth transfer between the greatest generation and the baby boomers. An estimated $12 trillion will change hands by the time this period is over. But an even greater wealth transfer between generations is already underway, and that's the transfer of wealth between the baby boomers and the next generation and their heirs. And it's estimated that wealth transfer will be as much as $30 million over the next 30 years. It's huge. A large portion of that wealth, of course, is derived from businesses, and family-owned businesses or some connection to a family business. So as a preeminent U.S. corporate trustee or fiduciary, Northern Trust and our office in Milwaukee has been devoting a lot of additional time and resources to help our clients address the concerns they have about wealth and the sharing of it with future generations, and how that might impact behavior of children and grandchildren. So while these concerns really aren't that new, what's different now is that the pace and the scale of wealth transfer between generations has really accelerated. And there are several key factors that have led to this acceleration of wealth that I'll touch upon in a minute here. First, we've enjoyed very robust capital markets since 2009, at the height of the Great Recession. The S&P, for instance, is up nearly 125% since January 1st, 2009. So those increasing asset values have allowed parents to feel more comfortable about transferring wealth to their children without jeopardizing their own lifestyle. Second, valuations on many financial and tangible assets have reached low points during the Great Recession, which makes it easier and more desirable for individuals to transfer assets with great growth potential from themselves to others. Third, the gift and estate tax exemptions rose from $1 million per person in the early 2000s to over $5 million today. The fear of losing these historically large exemptions after 2012 really prompted a lot of our clients to accelerate their transfer between themselves and their children during 2000. And finally, interest rates and inflation rates have remained low. Low inflation allows families to enjoy less erosion of asset values, and low interest rates provide low thresholds for achieving success at wealth transfer techniques. Low interest rates have also helped push wealthy individuals towards investments that have higher return potential. So those investments have generated, in the last 5 years, greater wealth that can then be transferred on to their heirs. Because of the scope and ability of parents to transfer such large amounts of wealth to their offspring, our conversations with clients that we're having now focus less on how much I can transfer to my children and grandchildren, and more on how much should I transfer to them. How much is too much? Do I really want to give them that much access to wealth at such an early age? How would this wealth transfer affect their lifestyle? Are we giving them incentives to be less productive people? So not surprising surprisingly, parents are seeking ways to engage in meaningful conversations with their children and grandchildren to impart a sense of purpose and responsibility with the gifts that they've made to the family. And ultimately, parents are seeking to ensure that their children and grandchildren become productive people and good stewards of the family legacy. Therefore, it's important for trustees like Northern to find ways to work with their clients and to engage different generations of family in conversations about the implications of wealth and its purposes. So where do you begin a conversation? It's not a straightforward answer, and it really in part depends on that particular child or person and the parent's attitude towards sharing that type of information with the next generation. It's our opinion that it's probably better to do it sooner than later, only because as people age, they need to know that these resources are out there. They're going to have to become comfortable managing them and working with the advisors that are put in place to help manage those. So there is no ideal age, but we find ourselves, when we're talking with clients, often having that conversation around college age, shortly after college, because that's a point where people naturally start to think about things other than themselves. They start to think about their future and their own plans for their eventual marriage, children, families. So they also start to have bank accounts, investments, some wealth that they have to inherit and start to manage or buy houses. So it's a great time to start to have basic conversations, talk about concepts of wealth, how we manage wealth, introduce people to advisors that are part of that family structure for managing the wealth. And then going on to discuss in more detail as they become comfortable and parents become comfortable some of the specifics of that particular family as well. So the framework for just having that discussion often revolves around what we call family governance. And that really is the family definition of the purposes and use of wealth and a gift that might be given from a parent to a child. So it's a great opportunity when you're making a gift like that to have a conversation, to impart some wisdom, some knowledge, some purpose as to what's behind that transfer and why you're making that transfer. That transfer can also lead to giving people incentives to lead productive lives, so that they don't go on a path where they don't feel they need to work, and also understand that they have a responsibility to and an expectation that they're going to have a good work ethic, that their parents expect them to have jobs to go out and earn an income and to be productive. Wealth transfer and the conversation of wealth also allows children and grandchildren to understand maybe they can pursue what we call maybe a noble profession that doesn't generate a lot of income for somebody, but is still a great career, teacher, somebody working in a charitable organization. So if they know they have that wealth available to them, they can think maybe differently about their career and what it is they do. Maybe do something that they really engage in and will ultimately lead them to a happy and successful life. And then the gifting process also allows parents to then also have conversations around what are the common family values that built this wealth and how it is that the children can then perpetuate it. So to have that conversation, we often find that there are certain vehicles or entry points for engaging the next generation in having a discussion with their parents or grandparents about the wealth that they have received and how they might benefit from it and how they can help the community benefit from it. And those vehicles often incorporate the use of a private foundation. Parents set up a private foundation with the idea of getting their kids involved in choosing a charity that might have an interest to them. And then they go out and select a charity, get the kids involved to make a choice and help define how the private foundation assets will be used in the community so they can establish a legacy of giving and to better understand that the family's wealth can be used for ways that they may not have otherwise considered. When the annual gifts are made from parents to children and grandchildren, it's also a great time to have a conversation about what it is you're doing, why you're doing it, and what your expectations are in doing it. And then, of course, lifetime gifts, which are now quite large, indeed quite large, also a great touch point to have a conversation with families. And then finally, memorializing in an estate plan, working with your advisors and attorneys to put together an estate plan that reflects your values and your goals in setting up assets for future benefit of children and grandchildren. As a trustee, we often find that sometimes, and more recently, the language that's in a trust is very specific to family, individuals, and concerns that make it sometimes difficult to administer. So, for instance, if you have a family member who has substance abuse problems, parents oftentimes now are incorporating language to make sure that the trustee is doing something to make sure that that child isn't using these funds that they've set aside to further a lifestyle that they don't condone or that they don't want to see their child partake in. As a trustee, it becomes a difficult job to administer a trust like that, but those are some of the things that parents want to see now in trust and incorporate into their estate plans to memorialize their belief system, the way they want to see their wealth used for future generations. So, I guess in conclusion, I say wealth that's being transferred is going to be much greater than it has been. The amount you can transfer at one time is much greater. So the issue of engaging the next generation of family members is going to be more prominent, more important, and it's going to be more of a focus for institutions like Northern Trust and everybody else who works in the estate planning business. And to that end, Northern Trust has also put together or formed teams that deal with and help clients have these interactions through family governance and family education, and to facilitate those conversations because they're going to be remaining important for quite some time.
So as I thought about what to talk about today, I wanted to do something different. And it's really a fundamental change that's taken place with our investment practice. And that's a focus away from talking about investing, determining asset allocation by things like Monte Carlo analysis, cash flow analysis, old school rules of thumb of taking your age minus 100, and that's how you determine your asset allocation. And that's how you determine potentially, do you have enough money to do what you want to do. You have to start with a very fundamental question that we call asset sufficiency. Do I have enough money to accomplish what I want to do? Do I have enough money to do all of these planning things, to talk to children, to use all of these techniques in terms of tax planning and estate planning to accomplish the things that I want to do? So we do that by focusing on, very importantly, what you want to do and what you have. So you inventory what you have. And this is a fundamental change that's taken place for the positive somewhat in the industry, but not very widely. And it's something we at Northern have not only championed, are practicing, but have really pioneered and been innovative, both in terms of our approach and some technology that we apply to engaging our clients in what we call goals-driven investing under the umbrella of life-driven wealth management. And so the inventory part of the assets, that's somewhat the easy part. Okay, you got your brokerage statements, you got your 401k statement, you have Bridgewood, and they've told you how much your business is worth. And here's what I have. Then comes the tough part. What do I want to do? And it's a great conversation to have, especially when you get multiple family members, husband and wife in the room, because they often can be quite different. So you'll talk about the real basic, lifestyle expenses. What do I need to live, pay my taxes, pay the grocery bills, utility bills, and all of those things. The second set of goals is what we call capital asset goals. So what do you want to do? Do you want to buy that next home in Arizona or Florida? Is it the yacht you've always wanted? Those are capital asset goals. What about, real importantly, philanthropy? Where do I want to give? When do I want to give? Do I want to just keep writing checks? Do I want to have a legacy? Do I want to talk about foundations for family members to engage in our wealth to champion our wealth, to champion our family. And then real importantly, family goals. Obviously this is where things get a little stickier. To what degree do we want to give money to our children? When do we want to do that? Do we want to fund grandchildren's education? Do we want to use 529s? Do we want to give money now? Do we want to tell people we have the money? Do we want to support them? Do we want to pay for weddings? Incredibly, that's one of the more lively conversations we have, is when husband and wife disagree on do we want to pay for the wedding and to what degree we want to fund that for. But incredibly, this process, this conversation brings up all of these things. You flush out all of these things, and then you employ techniques to determine how you allocate your assets from there. I'm going to talk a little bit about that process, and I want to circle back specifically because we spent a lot of time here today talking about business owners and their specific needs and how this approach can be of particular use for them. So we're going to talk about the allocation process and what this does for the client, for the investor. This does not only get them properly allocated, but what it does do, it gives them a great deal of confidence that they have enough to accomplish those goals by having it properly allocated. We all saw in 2008 and 2009, practically no matter how you were allocated, significant drops in market values. Confidence was shaken, and it was shaken a lot. But by having a proper allocation that's driven by your goals, the timing and the magnitude of those goals, that will give the investor a greater degree of confidence because the precision by which they're invested. So what we do is we take each individual goal, and we all just don't have 4 goals judged by these categories. We have dozens of goals because you have 10, 20, 30, 40 years of living expenses. You have philanthropy that you want to do every year. You want to set aside money for a foundation in 10 years. You want to buy that yacht. You want to give money to your children and take advantage of annual exclusion gifts every year until you die. And so you have dozens of goals. Each one of those goals is assigned its own specific asset allocation based again upon the timing and the magnitude of that goal. That allocation then is rolled into one single asset allocation to precisely allocate a portfolio to give the client, to give the investor the confidence that they can achieve those goals over time. Ultimately, that's what it's about. It's not about getting the cocktail party story rate of return. It's about taking your life's work and achieving what you want to achieve for your family, your favorite charities, for yourselves over the balance of your lifetime. So where is it especially useful for business owners? Several different times. Up front, do I have enough? What do I need to get for my business so I can accomplish my goals? Here are my goals. Is my business worth X amount? Is it worth 20 million? Does 20 million get me my goals? Well, no, maybe it doesn't, but my business is worth 10. How do I get there? Here we go to Bridgewood. We want to do a strategic acquisition. We want to grow our business over the next decade. So then I can accomplish all of these goals in the last 20 or 30 years of my life. Or conversely, I realize now I've gone through this. I really only have $10 million worth of goals. I've always wanted $25 million for my business, but I only know I can get 18 or 19. Now I know that's more than enough. I can move on to the next stage of my life. Set aside my ego a little bit, take the 18 or 19, pay my taxes, do some great tax planning, some estate planning, accomplish my goals. And then, from there, you move into the public markets. And that's something else that it's a focus of what we do in terms of education. So we're going to educate future generations on investments and how you invest money and properly allocate. But it's also the education of being in the public markets in a big way, oftentimes for the first time. I've dealt with a lot of business owners for the years, and the safety of their highly concentrated single business, safety in their mind, doesn't compare in their mind to being in the public markets every day. Because now they see their net worth change every day. And they become panicky, they become scared. And it doesn't just take 2008 and 2009. It takes the run-of-the-mill 10% correction for those people to see half of their money decline 10% in 6 weeks or a month or something like that. So we're going to provide them that education as well as about being invested in the public markets, and that's very important. But we dial them back to this. We dial them back to this to say, yes, you do have enough. That's accounted for. Those risk assets that are bouncing around, your global real estate, your stocks, your private equity funds, your hedge funds, that's okay. That's funding long-dated goals. So you, Mr. Client, Mrs. Client, that's okay. That's funding 15 years out, your grandchild's education. We have that taken care of near and dear in this high-quality bond portfolio. So this takes things to another level in terms of precision, comfort, and ultimately financial success for our clients in terms of investment management. So with that, I'll turn it back to Jamie and wrap it up.